Good afternoon, everyone, and welcome to today's webinar from Smith School of Business. My name is Meredith Dalton. I'm a business journalist at Smith School of Business at Queen's University. And I want to start today by acknowledging that Queen's is situated on the traditional Anishinaabe and Haudenosaunee territories. We are grateful to be able to live, learn, and play on these lands. It is my great pleasure to welcome you to today's panel discussion on climate reporting. I know this is a busy time of year, and so we're grateful to all of you who've been able to join us today. We're going to be learning more about why Canadian companies need to understand their climate risk and measure emissions and how to go about it. So before we get started with the presentation, I want to remind you that we will be recording this session. And so just by being signed up today, you're going to be getting a link to that recording in your email. You'll get it by email in a couple of days. I also want to tell you about the format. So we're going to have a short formal presentation from our first speaker, Dr. Ryan Rorden. Then we're going to have a panel discussion. And the entire time we will have the Q&A button available for your questions. We will be getting to those questions in the second half of today's presentation. So use the Q&A button if you want to ask us a question. If you want to have a chat, and I think you should, feel free. The chat function will be open, but the questions should not go there because I will not see them. They need to go in the Q&A button, and we'll get to as many as we can in the second half of today's presentation. So without further ado, it's my pleasure to introduce Dr. Ryan Rorden, Professor and Distinguished Professor of Finance and Director of Research with the Institute for Sustainable Finance. Dr. Rorden is also the head of the newly established Institute for Financial Innovation and Technology at Ludwig Maximilians University in Munich University. I also want to note that Ryan just got back from the COP28 conference in Dubai, and it's our pleasure to welcome Ryan, although he's not here. Here he is. Turn himself. There he is. So Ryan, I'm giving you the floor. You've got a few minutes, and then I'll be back to introduce the rest of our panel. Thanks.
Great, thanks. Hope it's not the floor. It feels more like a screen. And speaking of screen, I'm going to try to share. Here we go. Yeah, thank you very much, Meredith, for the kind intro. Thanks everyone else for tuning in. Yeah, I just got back from as my wife calls it, my vacation in the sun in Dubai. Yeah, but that's not necessarily what we'll talk about today. So as always, I have about 10 minutes to give a little bit of background, and I've prepared 70 minutes of slides. So hopefully I can do this in a way that is time efficient. I thought what I would do is I would set the stage a little bit for the discussion that we're going to have, and also provide a little bit of background on what's happening in Canada, what's happening in the world in terms of disclosure. So some of the questions that I think are important, and I think are important to sort of firms in general, is what is it, what do we need to know, and how is disclosure going to work? And the main questions I have is, well, why disclose on climate? Is there a good reason for it? Is it important financially? Is it important environmentally? Is it important to our balance sheet? Why do we do this? And as a sustainability person, just in general, not thinking with my business hat, is, well, do disclosures help actually lower emissions? This is a question I think is not necessarily answered yet, and I hope the answer is yes, but that's one thing that we should be thinking about. And then the difference between voluntary and mandatory disclosures. Does it matter if we have a mandatory disclosure regime? Are voluntary disclosures enough? Not sure we have the answer. Global standards. So we're slowly in Canada, the United States. I'll talk about that more in a couple of minutes. In the EU and sort of across the world, we're coming in with standards about disclosure. What do we disclose? How do we disclose it? And I think that's an important aspect on top of it. And finally, well, we have to verify emissions as well. So we can disclose anything, but if it's not being verified, then it doesn't have nearly as much teeth, and it might not be useful for capital markets, for allocators, for regulators, or for risk managers. So these are all things that I think we need to consider in terms of disclosing emissions. Who's going to disclose what, right? I mean, we hear about greenhouse gases, we hear about CO2 at COP28. One of the main focuses was on methane. So methane is 80 times more potent. And so we really need to think about what it is that we're going to disclose. And in that respect, really what we think about is scope 1, 2, and 3 emissions. And so direct and indirect emissions, and usually in terms of their CO2 equivalency. So how much methane am I emitting, and how much is this really in CO2 equivalent? Then we need to set some targets, right? Not only do we want to know what firms are currently emitting, but what are they planning to emit? and setting a target to get to net zero, just to get to zero emissions. And risk disclosures, I think, are extremely important. I think the average person has a difficulty thinking about what a ton of CO2 is, or what a megaton is, or a kiloton. And I think what's really easy for them to understand is, well, what are the financial risks for a firm associated with our emissions or emissions profile? And that ultimately ends up in the balance sheet or in an income statement. And then we're back to fiduciary duty, and it's much easier in a current framework. Investors and lenders, both of them need to know the emissions of the firms that they're investing in and lending to. And it matters for public and private companies, right? This isn't just a public company issue. This is also a private company issue in small and medium-sized enterprises. There are costs and benefits, right? Compliance costs are high. It's hard to get the data. Sometimes hard to collect the data. It's hard to verify the data. It's hard to find people that know what to do with this data once they get it, and how to collect it and how to report it. So there's a competition for skills. But it's also important in terms of access to capital, right? I mean, right now, I wouldn't say that capital is being particularly rationed with respect to green or brown firms, or to emitting or high emitting or low emitting. But at some point, this might actually be an access to capital question. And then net zero planning, sort of how do we get there? What do we invest in? What are the technologies? Is both an opportunity for firms that are developing the technologies, but also a cost. There are quite a few climate disclosure regimes across the world. The European, and these are just the mandatory ones. So the EU just recently came out with their Corporate Sustainability Reporting Standard, or CSRD, and their Sustainable Finance Disclosure Regulations covers scope 1, 2, and 3. So it's a very broad and sort of sweeping set of regulations. The UK has their streamlined energy and carbon reporting, and a climate related financial disclosures. And see, these are scope 1 and 2. They're working on including scope 3. The US, through the SEC, is proposed for 2024 scope 1 and 2 and 3 coverage. And that's the same with the Australian Treasury is also proposing something similar related to what the SEC is proposing, also for 2024, also covering scope 1, 2, and 3. We have voluntary disclosure standards. We've got CDP. This is the data set that we use quite regularly at the ISF. We've got IFRS. We've got the TCFD, the Task Force on Climate-Related Financial Disclosures, SASB standards. So there are a number of voluntary standards, as well as the mandatory disclosure standards. Now, just in Canada in general, we have sort of a mixture of disclosure, and I won't go through all of them in too much detail, but one of them is that we've got a facility level disclosure for greenhouse gas reporting since 2024. So this is mandatory and this is pretty much the only mandatory disclosure framework that we have in Canada for any facility that emits more than 10,000 kilotons, or 10,000 tons of CO2 equivalent. It's used for tracking to sort of, at a facility level. And the important thing is the data is public, so anyone can go and look at it. You can review it and see, the facilities close to you or far away from you, what do they emit, and where are they? New proposed regulations are going to be put into force, and these are with respect to climate risk. So this is an OSFI regulation on climate risk. It was set out in March. It's going to set mandatory expectations for all of our large federally regulated financial institutions. So this really means that the big 5 financial institutions. It's going to include scope 1 and scope 2 reporting for the big banks, and it's really related to climate risk. So it's more getting towards the sort of the financial impacts of disclosure, and less so on the environmental. Of course, the two are linked, but I personally think that going more towards the financial risks associated with it might end up having more positive or effects on the amount of emissions reduction we actually find. But I'd love to hear what the panelists say about that. In general, in Canada, we've got a pretty good, disclosure. We've got between 69% in 2020 and 72% of S&P TSX firms disclosing their greenhouse gas emissions. We have a somewhat smaller group of firms that are setting targets for reducing greenhouse gases. So disclosing, yes; targets, less so. More so in terms of the large Canadian firms, and less so in terms of the number of firms. And with that, I would like to hand it back to Meredith and hand it back to the rest of the panelists to get into a bit of a discussion. Thank you.
Thank you very much, Ryan. There's lots there. I have already lots of questions, but it's my pleasure now. I want to introduce the rest of our panel and then we'll get into it. So first, Omolola Fashasin is a principal with the Canadian Sustainability Standards Board. In her role, she contributes to technical research to support sustainability standards proposals, conducts outreach sessions to gather feedback on proposals, and presents results and recommendations to drive decisions, thereby helping to shape the future of sustainability standards. Welcome, Omolola. Ryan, you can come back on. I don't want you to go away. You come back. We're building our panel here. Thank you. David Ong is a director on Manulife Investment Management's Global Sustainable Investing team, responsible for ESG integration and stewardship initiatives to support Manulife's Canadian portfolio management teams. He has been particularly involved in the responsible investment industry for the past 7 years as an ESG consultant for Milani, the HEC Montreal Pension Plan, and Vigio Iris. David is also president of the advisory committee on the Principles for Responsible Investment Quebec Network. Thank you for joining us, David. And finally, Jeff Pegg has led the sustainability strategy at TELUS for the past 12 years. Jeff established TELUS's long-term climate change and waste diversion goals, targets, and action plans. He also initiated TELUS's leading practice of linking executive and team member pay to sustainability objectives and led efforts leading to TELUS issuing Canada's first sustainability-linked bond. In 2020, Jeff was elected to the boards of the Canadian Business for Social Responsibility and the Global Compact Network Canada. All right, panel, here you are and looking fine. So what I'm going to do, and Ryan, I just don't want you going away, but what I want to do is give each of our new panelists a little bit of a spotlight before we get into a bigger group discussion. So Omolola, and I understand I'm going to call you Lola just for ease of speech. Can I get you to wade into what's been described as the alphabet soup a bit when it comes to climate reporting? So describe some recent events, recent history of standard settings for sustainability disclosures, and particularly climate disclosures, and maybe give us a sense of the kinds of things companies are reporting on and how they're doing that. Thanks.
Absolutely. Thank you, Meredith, for the kind introduction. I'm pleased to be here among fellow panelists and to have the chance to contribute to this very interesting conversation. And now to my response. I would say you've asked a very interesting question. If I think about it, sustainability reporting has evolved through various voluntary standards and frameworks, including those of the Global Reporting Initiative, for example, the Sustainability Accounting Standards Board, SASB, the International Integrated Reporting Council, IIRC, the Carbon Disclosure Project, the CDP, the Carbon Disclosure Standards Board, CDSP. Sorry, it's a mouthful, so many acronyms.
Serious alphabet soup you're talking about, yes.
Absolutely. And then let me mention one more, the Task Force on Climate-Related Financial Disclosures, the TCFD. Well, these frameworks plus others, which you've mentioned, can be referred to as the alphabet soup. They generally align in the broader objective of promoting disclosures. However, they exhibit variations in specific details and approaches when it comes to the reporting criteria, the scope, the focus, the methodologies, and so on. I'll cite a few examples. The GRI standards, for example, require general disclosures such as governance, stakeholder management, reporting practices, and all that. The CDP on its side focuses on disclosures centered around climate change impacts, water impacts, and forest impacts. Moving on to the integrated reporting framework that aims for connectivity in reporting. While SASB standards then focuses on detailed requirements for reporting by topic and industry. The TCFD on its own end requires disclosure of information along 4 pillars, being governance, strategy, risk management, metrics, and targets. So you can see the variation that can arise from this and all that fragmentation and all that.
Right.
But the good news is, yeah.
No, keep going, please.
Okay. So the good news is this, the alphabet soup is changing and it's changing for good. And this is due to recent events. I'll talk about 2 very briefly, and I hope I'll get a chance to talk about it in details later on. The first is the creation of the ISSB a couple of years ago at COP26. and then the recent launch of its inaugural voluntary standards last summer. Now, to the second part of your questions, what have you been seeing companies reporting on? We should note that some companies have been on this journey for quite a while now, while others are just starting. However, for people that have been on this journey for a while, we'll see that the push for investor grade or financially relevant information, particularly those linked to climate risk, has started to ramp up in recent years. So although companies report generally on their sustainability matters related to their given industry, we are now seeing more universal mobilization around topics of GHG emissions, emission reduction strategies, amongst others. And of course, closely linked to that is the cost and timing implications of all this.
Okay, I mean, it's a lot. And for companies that are new to it, I can only imagine how difficult it is to navigate this soup, as you say. And in general, I mean, are these standards generally seen as mandatory or voluntary, what you're seeing?
Oh, sure, yes. So the frameworks I've talked about are all voluntary. Ryan did a good job in his presentation to show us the mandatory, which are more jurisdictional in nature, things like the ESRS and all that.
Right. Would you say that we're getting close to a universally accepted method for reporting on a company's carbon footprint and climate-related risks?
Absolutely. So we're witnessing significant strides towards achieving that universally accepted method. So I'll start with the establishment of the ISSB. To me, that's the starting point. And I believe that was a pivotal step in standardizing that reporting landscape. Next is a recent release of the inaugural standards by the ISSB. I'm talking about IFRS S1 and then S2, which is linked to the topic we're talking about today.
Okay.
Now, these also marked a critical milestone in this journey towards uniformity in reporting. Now, these S1 and S2 are built on, they're not only built on the TCFD recommendations, but they're also strongly influenced by the work of SASB, the IRC, and the CDSB. Now, my third point is very linked to the second point, and this is the consolidation of various initiatives into the ISSB. I believe that these has played a key role in reducing that fragmentation, the need to cater to different requirements across different frameworks. Now, there's been that consolidation and things are now, taking shape, things are now being consolidated. Additionally, I'll say that the widespread international support for the work of the ISSB actually underscores its significance, meaning that there is wide support for that consolidation to happen. And we would see backing from entities like the IOSCO, which is the International Organization of Securities Commission, the Financial Stability Board, the G20 and G7 leaders and all that. So these signify a global effort towards embracing standardized reporting.
Okay.
And lastly, I would say that the ISSB's efforts towards interoperability, notably with other jurisdictions like the ASRS, you'd see the ISSB talking about that also with the GRI and all that. So I think it further demonstrates a commitment to harmonizing all these reporting practices across diverse environments. I'll stop now.
Woo, I got to tell you, those of us who are not in that world are going, wow, that's a lot. There's a lot to learn. I want to shift the spotlight over to David for a minute. So David, I want to ask you about what investors are looking for these days when it comes to reporting from the companies they invest in and how we've seen that evolve in recent years.
Yeah, great question. And thanks for having me today. I've only been in the space for the past 7 to 8 years, and it's crazy how we've been evolving in the space from disclosure, target setting, right? And now I think where investors are going at is really about real evidence of companies walking the talk. We need data to show evidence, but we also need concrete plan, right? So there's really a shift going from just climate reporting of your GHG emissions to really a broader scope where, okay, what are your targets? What are the 2, 3, 4, 10 action items in 2024, and how that will drive some real impact in the world in your decarbonization pathway. Make it a little bit more tangible of what we're looking for. We're looking for data that we can use in our evaluation model. So talk to any investor, what they want to know is how much cost, how much additional revenues your decarbonization pathway can drive, and what are the time horizons, right? Are you spending money today? Revenue coming in, when and how? we want to understand their assumptions as well. So I think, Ryan, you touched on that on balance sheets, financial statements. So there's a thing called climate accounting is becoming more and more topical. If companies, first of all, there's already an issue if climate change consideration are not being used in financial statements in many different cases. But if they do use it, then what are those assumptions? And are they making multiple scenarios? Because we do know that it is challenging to forecast what will happen in 10, 20, 30 years, right? Um, but we're also really asking companies now to think outside of the box. Climate change is not just about carbon emissions, biodiversity, water, think of supply chain, local communities. So everything is intertwined. And I think companies need to, when they talk about climate change, they need to also expand the scope and not just focus on, okay, my carbon emissions at XYZ 2022 and where it's going to will go in a couple of years. We do definitely support ISSB as a foundational framework for data reporting. But I think companies do have the option to go beyond ISSB. It is definitely great, but double materiality is going to be a thing because Ryan said it, access to capital. Investors want to put their money aligned with their values. They want to solve these issues. But so companies really do have an opportunity to explain the double materiality aspect of their operations. What are they doing to really have a positive impact on communities, on their customers, on the different stakeholders? And finally, we often talk about the E, we isolate the E, but what about the G, the governance piece? Well, there's people taking decisions, right? And decisions are not always great. It could be some decisions are great, some decisions are bad. So definitely looking at governance, executive compensation scheme, and how those climate targets, goal objectives are really tied to their executive compensation scheme so that everyone walk in the same direction. So I'll pause there. I can probably speak for another hour on why is it important for investors, but
Well,
I'll
so
pause there.
right. I've got a follow-up question for you here, which is how do you deal with investments in high emitting companies like the oil and gas sector? So we're going to get a bit more specific here when you're trying to work towards your own climate targets.
Yeah, no, great question. I think start with clear understanding of the risk and opportunities in the full entire value chain. And I think this is why we've been hearing a lot of discussion about scope 3, right? Just to give you a tangible example of how that applies to my day-to-day, I open up, I wouldn't name it, but a midstream oil and gas company. I look at their carbon disclosure project and the acronym is CDP, and they disclose on the risk and opportunities of climate change, right? So I look at the opportunities, it's super great. There's a lot of opportunity in terms of scope 3 downstream. What can they do to lower their carbon intensity in the product they're offering to their consumers? I look at the risk, they talk about scope 1 and 2, but nothing about scope 3. And Ryan, you just came back from COP28. There's a dynamic shifting right here about supply and demand. Company need to think about the product they're offering and what are the risks in terms of demand going forward in 10, 20, 30 years, and how does that apply to the entire value chain upstream, right? Coming from the suppliers too as well. But when we don't see that type of information, there's a piece of the puzzle that's missing. So we need to continuously engage with companies and we're not blaming them, it's challenging, but we need to partner with them so that they understand why we're asking for additional data so that it doesn't create any ESG fatigue in the space. And then from the data, now when we need to understand their strategy, what is the game plan? How are they going to get there? Engagement activities, key to us so that we can have this partnership dialogue with companies directly. And at the end of the day, when we include all of that in our evaluation model, this is how we can assess the climate trajectory of a high emitting company and if their plan are credible or not. Because at the end of the day, we respond back to our client and we explain to them that we included certain names in our portfolio and why do we keep them? Why do we believe in them? And I think the key issue about reporting is about trust. And I think this is key.
Okay, that's great. Thank you. I'll get you to stop there. And I just want to shift over to the telecommunications sector now. So Jeff, I want to bring you into the discussion. The question for you is from the side of issuers and reporters, from a leader in the field, what does climate reporting look like in practical terms? And what is TELUS doing in this regard?
Yeah, well, thanks for having me, first of all. Well, if you listen to Lola and David, everything that they've discussed is something that a practitioner is going to have to consider, right? What are all the regulatory requirements? What voluntary standards do you want to align to in terms of your disclosure? Who are your stakeholders? For example, investors, could be customers, could be your employees, could be suppliers, could be governments. And then what's expected of you from them? And then what are the risks, of course? So what are you doing to de-risk your organization to the impacts of climate change? And also, what are the opportunities, right? And how do all of this relate to your overall business strategy, let alone your sustainability or ESG strategy overall? That's sort of the frame in which you're thinking as a practitioner.
Right.
Presuming that you want to take advantage of these opportunities, you want to address the risks, you need to go about collecting data primarily. That's the first thing that you really need to do. And that starts with, for example, utility bills, right? A lot of operational emissions, particularly your scope 2 emissions, will come from your electricity or natural gas use, for example, right? Or if you have a fleet, then your scope 1 emissions will be fuel for your fleet, for example. You got to collect all of that data. How are you going to collect it? That's another thing, right? Spreadsheets, manual into bills, or increasingly software applications, platform applications, data aggregators. There's so many different things that you need to decide on. Oh yeah, well, when you get into that, who's going to have access to it? How many different people? How can you automate? Or could you have APIs that can pull data from different systems? So then you're engaging typically, your IT expertise within your organization to help you and assist you with that. There's an ongoing training aspect to all of that as well. But let's presume that we've got there, you've got some data, then what do you do with it, right? And by the way, operational is a challenge. I've just talked about that. But then you start talking about your scope 3 or your value chain emissions. How am I going to work with all of my suppliers? You may have 1, 10, 1,000, 10,000 suppliers, depending on the size of your organization. How are we going to work with them to get data as well? And then I wanted to get into, the governance part of that, which is very important. And I agree with David, is once you calculate the data using the protocols that are out there for either your exact emissions or CO2 equivalents, as Dr. Riordan said, do you get a third party to help you verify that data so that in essence you can continue to build trust with your many stakeholders? We'll use David's example with investors who are definitely looking for that third party verification because they want to align their values, as was said, with your own organizational values as well. So that's a lot saying there. You may also think that when you do this and you disclose your emissions portfolio across all scopes, that not only are you building trust, but you may have a competitive advantage if your competitors aren't doing that, right? So if you're in an industry, all things being equal, let's just say pricing or customer service or something along those lines, maybe your fulsome strategies and disclosure with respect to your climate will be that differentiator in the marketplace as well. So that's the practical view of what is considered.
That's great, Jeff. I'm actually wondering also, because you've done a lot at TELUS, can you talk to us just a little bit about what TELUS is doing specifically when it comes to climate reporting, or is that too much to dig?
I can quickly go through that. So we do have, first of all, have targets, and we had targets as far back as 2011, and they were 2020 reduction targets for absolute energy use reduction and GHG reductions for scope 1 and 2, or our operational emissions as well. We met those targets, so we reset some new targets and added to them. So not only do we have scope 1 and 2 reduction targets, we also have scope 3 reduction targets. All of those are approved by the SBTI, another acronym, Science-Based Target Initiative, which, you know, them amongst a couple of others are looked at as a gold standard when it comes to, you know, all your targets are aligned with the 1.5 degree scenario. Excuse me. So we're doing all of that. We're disclosing. We've also tied our scope 1 and 2 emissions reduction to sustainable finance opportunities in the organization. So you did mention off the top in my introduction that we issued Canada's first sustainability-linked bond. We've done 4 others subsequent to that. We also have new requirements to report on our progress annually in a public forum. And we have, you know, the interest payable is tied to our successful achievement of meeting those targets as well. So we disclose through CDP. On the scope 3 side, we are working with suppliers and we've set targets as well of having our suppliers disclose through CDP. We help them with that process. We also have internal targets with respect to having our suppliers set their own SBTI or equivalent type targets as well. So that's what we're doing on climate.
Okay. That's really great background, and I've just noted we've got lots of great questions coming in. I want to ask you guys, I want to get a discussion going. I know it's hard because there's so much material, and then you guys have these great specific examples, which are all quite different. But on the capacity side, what can be done to make life easier for reporting firms? And should companies be worried about making mistakes in their reporting? Can we take that one on? Lola, can I point to you first, and then the rest of you can jump in?
Yeah, I'll be happy to take the lead on that. I think I would say there are several strategies to ease the burden for reporting entities. Firstly, guidance plays a very pivotal role, and there's support available in that regard. The ISSB has issued both application guidance, illustrative guidance, even with examples to assist entities as they adopt these standards. Education and awareness is another thing. I would also say that there's a lot going on in that space. Just this morning, I saw this email come through that the ISSB just released an educational material on the nature and social aspects of climate-related risk and opportunities. Again, another material that can support the adoption of IFRS S2. Also, numerous thought leaders, such as the Institute of Sustainable Finance, CPA Canada, and other notable thought leaders in this area are also contributing actively to this domain. Also, the ISSB recently launched the ISSB Knowledge Hub, which serves as a comprehensive resource center, and it offers a wealth of capacity building materials and making it that one-stop destination for reporting firms to go to. And also on the part of the firms themselves, I would say that engaging in collaboration and partnerships amongst themselves would also help. That can create access to best practices or even the possibility to collaborate on innovative solutions. To the second part of your question, should entities be worried about making mistakes in reporting? I mean, it's a valid consideration and it's an interesting one. So to start with, we should recognize the newness of all this across board. We're all in the same boat, it's all new to everyone. So what does that imply? No one can, and as a matter of fact, no one should expect perfection on day one. So we'd urge companies to start somewhere. Just start, don't wait until you get everything right and set, you probably will not start if you go that route. And the second thing is for entities to start sooner rather than later. How do you start? It could mean, simple things like being acquainted with the standards, understanding the internal processes, understanding the data collection and reporting implications. And as companies embark on this journey, they get better, they develop expertise, they navigate the learning curves. No doubt it will be bumpy, but somehow, no doubt, over time, the quality of reporting will evolve and improve over time.
Right.
Now, let me quickly balance that before I yield the floor back to you. Let me quickly balance that out, to say that. So on that, and we recognize there's going to be a learning curve. No one expects perfection, but also on the other hand, we expect companies to take this seriously. The whole purpose is to inform investor decisions, what we call investor grade information. So, and you see that there's a lot of activity going on around the sustainability assurance standards. So in a not too distant future, I'm sure very soon, that same level of rigor and auditability that applies to financial reporting will be expected of sustainability disclosure. So in summary, what am I trying to say? While leniency might exist in the early stages, might not last for long. So there's that growing expectation for accuracy and credibility in the coming years.
Okay, that's super. Does anyone else want to weigh in on that? Anyone have anything to add that Lola didn't cover?
I could just throw in one quick little one quick little point that I sort of always try to and I think it follows to your points as well, Lola. I think that when people that come to a webinar like this, like, oh my God, there's just so much here, I don't really understand it. But
Yeah.
just tracking the tons of CO2 that you emit, and then you think, oh, I don't know how to do that. Well, then just track activities that you know are related somehow to emissions. So I drove a kilometer, I flew 1,000 kilometers, I heat my buildings, whatever it is. And then there's really easy translation factors. A kilometer is equal to this many tons of emissions. A flight is equal to this, and it's much easier, I think, to start. I mean, the hard parts, Jeff, you mentioned them are, well, we've got 6,000 suppliers or 10,000 suppliers, or trying to get to scope 3. Don't worry about all that stuff. Just do some really easy activity tracking, translate that into something. It doesn't matter if you're off by 25% or 50% in terms of what your actual emissions are. We can always, as I would say, as a researcher, we can always reduce the confidence interval over time, but just start with a point estimate with a really big confidence interval and work from there.
Isn't there an old saying, what gets measured gets done?
Yeah.
Jeff, sorry, go ahead.
Well, I was just going to echo that. I think that's very, very practical for an organization. You can over time replace your proxy data with actual data and do a restatement. And if you are clear in that and always talking about the scope of your reporting when you're disclosing, I think that's fine. I mean, whether it's a mistake or just a change or an evolution, I think that's fine. And you can maintain that trust that's required if you're transparent and saying, okay, last year we said this is what's changed. Here's what we've done about it. And here's the new results.
Right.
And I think that is always, well received. And I just also wanted to double down on one of Lola's points, which I 100% agree with, is the ongoing need in this space for education and awareness. Because if you just start talking about carbon, okay, let's leave it there. It depends on what audience that you have, and it brings different things to mind for many different people. So I think that ongoing need for education and awareness, and that could even be internally at different parts of your organization, that's required when there's decision making that needs to be happening. Are you going to do some data analysis, right? So that can't be understated.
I want to ask specifically about we've talked a lot about kind of bigger businesses, large organizations, but what should small and medium-sized businesses be thinking about? What do they need to be prepared for? And when it comes to this stuff?
Yeah, I mean, unfortunately, I think it starts with the challenges that are inherent with this, right? One is capacity and resources available, right? So if I extrapolate that to a small and medium enterprise, it's sort of obviously the backbone of the Canadian economy is, do you have an expert, a GHG expert, for example, in your ranks? Probably not.
Probably not, no.
Right? I mean, so what can you do? And realizing that resources are key. Let's also say keeping up with these regulatory and voluntary standards. You need resources to do that. I mean, Lola went over all of that, did a great job of summarizing all of it, but it is overwhelming, right? And that's something that I took away from that. So,
I see some people popping up in the chat. Actually, I think this is a great place. Those of you who are small, go ahead and chat this out.
Oh, sure.
There's a lot of people with a lot of experience and ideas in this who are in attendance. So go ahead. Sorry, Jeff.
No, I think it's great. And then those are really practical. I think one of the key areas to start at, and David really touched on it, was materiality, right? So what are your own expectations as an organization matched with what your stakeholders or rights holders are expecting of you, right?
Yeah,
and you have to start there, because it might not be the end state, right? It might just be an example that Ryan gave, right? Which is like, just start here, just start talking to us about what your emissions portfolio consists of in terms of sources, right? So I think that's something where you need to start. And I'll just say one last thing before we move it on is rely upon, those who which you collaborate with, like industry associations or NGOs that can help you with practical hands-on and help, or education and awareness on the topic, and from a practical sense.
Yeah, that's good advice. David, I saw you unmiked, and I know you wanted to jump in there. Do you want to add anything?
Well, I know it was a great moment to talk about the benefits. I think there was a couple things that Lola and Jeff and Ryan did talk about, why that could be beneficial for companies. But I just want to state that why is it beneficial for investors when you come to climate reporting? Our duty is to respond to the needs from our clients. So when we think of finance, it's not it's really important that we remember that we are protecting the asset of beneficiaries. So we're talking here about teachers, workers that will need a pension plan, need to make sure that they will have enough money when they retire. And some of them will retire next year, and some of them will retire in 30 years. So that is super important. And if we don't have great data, how do we assess risk and opportunities in a great way? So this is, for me, this is super key. And then obviously it leads to other benefits, which is more research, robust research. Ryan talked about there's plenty of blind spots right now. But if you don't have the data, what do you do when it comes to research, right? Thirdly, think about regulations. When you have 60, 70, 80% of the stock market reporting on GHG emissions, makes things a little bit easier to have some sort of carbon tax or regulation in the market. But if you don't have data, how can you how can government implement a new regulation tomorrow? There's nothing to base on, right? So this is, for me, another benefit. And I was thinking about two things on small medium enterprise. Today, large cap companies have their carbon targets, and what do you think they're going to do? They're going to go to their suppliers, small, medium enterprise, and they're going to say, are you compliant? And I think this, as SMEs, it does take resources, but the ones that already do the work today will benefit potentially tomorrow, and even maybe today, whenever it comes to RFPs, right? To be the supplier, chosen supplier for large cap companies. And I saw a question in the Q&A. I cheated. I looked a little bit at the Q&A. There was a super great question because someone asked, and I really like that question, why David is talking about single materiality and then suddenly double materiality. And that is why climate reporting is so important, because we respond to many different clients. I can't impose any values to anyone. Some really want to protect their assets. I need single materiality. Some want to put the monies aligned to their values. And this is where, for me to say that company ABC will fit your values, and this is why I can put it in the fund, climate fund, sustainable funds, whatever you want to call it. I need trust in data. I need evidence that you're doing something. And I think this is where companies get access to capital in those upcoming thematic sustainable funds. And consumers is important. You are a consumer, whoever's in the audience, pension plan, retail. If you don't ask questions, you don't push us, obviously double materiality will not be as important. If you do the opposite, double material, trust me, will be really, really important going forward.
Okay, that's great. I want to get to a few of the audience questions. There are lots and they're very good. We've got a question about the concern for greenwashing criticism. So how can a company starting their disclosure journey demonstrate transparency to avoid these criticisms, especially as they're still using proxies for their reporting? Anyone want to take on that issue?
I mean, I can start, I suppose, and yeah, I saw that question in there too. It kind of goes back to what I stated previously, like just be transparent in what you're doing. Here's the scope of what we're talking about,
Okay.
right? And then when it comes to scope 3 in particular, which is, let's face it, for most organizations, they're not, and not everybody is using 100% actual data. There are a lot of proxies used based on the protocols that exist. And it's very common, by the way, for organizations to, especially with a third party, reassess their scope 3 as they replace proxy data with real data over time, even the largest organizations that are out there, and just talk about it in a transparent manner.
Okay.
That's-
Is it
Can I-
possible, like, are people getting criticized for greenwashing when they're making these efforts towards climate reporting? Is that something that comes up that you've heard of?
I mean, I
Can I
guess
maybe
it can. It's so sorry, David. I'll just quickly say, it's under scrutiny. So therefore, something like a third-party verification can go a long way to, helping you avoid those claims as well. So it's not just because we're saying it. Here's a third party that's saying it based on some standards or protocols that they're using to test your data. And there is a general trend, as we know, to align non-financial reporting standards, which includes climate emissions disclosure, with financial disclosure in terms of the rigor and controls around that data. So that's, Lola touched on some of this coming together. That's happening, and I think that's in part driven by these concerns around possible greenwashing. Go ahead.
Okay,
Sorry.
David. Floor is yours, David.
Thank you. I fully agree with Jeff, and I think one thing that we suggest to companies these days is to really have transparency on what they do and what they don't do yet, and they're planning to do going forward. So, and it goes beyond climate. Is on every ESG issues, right? When you say you care about your employees, human capital is key. Well, and you have great data. Obviously, I can't believe that there's no issues at all in terms of managing your workforce. So what are the challenges? What are the things that you have accomplished? And what are the targets going forward and the action item in 2024? I think these type of disclosure in a simple format table, like these are the issues, these are the challenges, these are the things I'm planning to do going forward, will help people avoid greenwashing accusations. Because often companies may be inclined in reporting things that are great without putting the other side of the medal, and this is where you get greenwashing accusations.
Got it. Okay, thanks.
I would just add one quick little thing. I promise I'll be quick. I wouldn't worry about greenwashing concerns too much if I'm a firm reporter. And most of the things we're worried about with greenwashing are, large mutual funds, so DWS, the carbon removal, the voluntary carbon markets. Those are really where we're, I would say, more concerned about it. A firm disclosing emissions based on the GHG protocol or any kind of accounting protocol, I've rarely heard anyone that's super concerned about that. And so I would just say report. And I've got some research out that says that it doesn't matter what it is you're reporting. If you're doing some sort of reporting on emissions, it's good for you.
Okay, that's really helpful. Somebody in the questions is asking, in fact, can you guys point to some of the best in class companies when it comes to reporting financial emissions, category 15 of scope 3? Is that the kind of thing we can spring on you? Are there any that come to mind as companies that are doing a super job that we?
I think in terms of financial institutions, the one that comes to mind for me is HSBC. There's one of the only ones that I've seen sort of that report the amount of financed emissions, that do I would say a good job of it, sort of showing the path towards them across different industries. I'm not saying they're the best in class, but they're just the one that sticks. Not that I go and read every single finance emissions report, but that's one that's stuck in my mind.
Okay. Anyone else want to weigh in? David?
Yeah, maybe a great easy way, it's not perfect, but it's a starting point, is there's a thing called PCAF, Partnership for Carbon Accounting Financials. If you go on a website, you can see a bunch of companies that are committed or actually did something on this using the PCAF methodology on finance emissions. A lot of financial institutions globally, but also here in Canada. The challenge that, because it's new, because everyone is learning, you would see that Bank A versus Bank B may not disclose in the same fashion, but they're moving toward some sort of like standardizations, but it's a starting point. So when you see a company already in the PCAF list of signatories or members,
So
it's a good sign.
PCAF again? PCAF is, say it again.
Yeah, PCAF, Partnership for Carbon Accounting Financials.
Okay.
It's public, is free. You can go on the website.
PCAF, somebody wrote it in the chat. Thank you. Anyone else want to weigh in? Lola, did you want to weigh in on any examples that you'd like to point to?
None comes to my mind readily.
Okay. It's not fair to bring it on you like that. So, okay. So thanks. And I guess the greenwashing, I'm curious about this question. We're a travel company doing offsets through the gold standard. What's your opinion on that? Are there better options than that, I guess, than offsets? Anyone want to speak to that one?
I like offsets. I think the markets are in flux right now. And so if you're going to do it and you're actually serious about doing it, you should look for removal offsets or removal credits. And, you know, another sort of caveat is if you're paying $3 for removal of a ton of CO2, it's probably not actually removing a ton of CO2. I think the unfortunate truth is that, you know, a ton of CO2 to remove it is probably in the order of $100 or $200 in real economic terms. And if you're trying to buy certificates, offsets that are an order of magnitude less than that, then that's when I'd be worried about greenwashing.
There you go. Okay. Anyone else want to weigh in on that? Or can I go to this this question, which is a bit more general? Could the panelists elaborate on climate accounting? Is there a consensus on the conceptual framework of climate accounting, to borrow from accounting lingo? Where on financial statements do you see climate reporting appear? For example, existing or new line items. So some very practical questions here. Does anyone want to take those?
I can take that one since I mentioned it, so I
Yeah.
need to be able to respond to that one.
Okay.
But disclaimer, I'm not an accountant, and this is a great opportunity for young professional students if they want to go into green accounting. This is for you. There's no consensus yet on what we need to look at, but we're already seeing oil and gas companies or other type of companies disclosing in the financial statements some of the assumptions and how that affect their forecasts on things like AROs, which is asset retirement obligations. This is one item in the balance sheet, but things on a more high, so this is really specific to the retirement of some of the assets and the forecast and things like that, and how that drive additional potential cost or amortization impact. But if we take it more from a higher level, think about impairment, think about CapEx, think about forecasting revenues. These need to be taken. I mean, you need to take climate change in consideration when you make those type of disclosure or forecast in your balance sheets. So we're seeing more and more of those, and recognizing in the balance sheet as well. And there's a risk section, and where you outline a lot of different risks, such as cybersecurity and geopolitical risk. Climate change should at least be in it, in my opinion.
Okay.
I could
Yeah.
throw one sort of additional thing in there. I know we're pressed for time, so I'll be quick. But so generally what I find is you see a lot of the stuff is just being reported separately in a sustainability report. So you might have someone has a fiscal year end of March, and then sustainability reports often come out in June. And so they're kind of off cycle with financial reporting. And I think at some point they should just be part of the normal financial reporting cycle and, part of the notes, or just as David mentioned, sort of really just included in there. And so right now it's separate. Yeah. And it's got a note there. This is going to change, but right now that's the way it is for the most part.
Okay. You know what, yeah, sorry, Lola. I just wanted to make sure that you guys, if there are questions you really want to be answering in the chat, because we're not going to get to all of them, just have a look. Lola, go ahead and respond. Thanks. Sorry.
Yeah, so I was going to say that, over time, we're going to also see that, which I think Jeff just mentioned about that alignment in reporting. But more importantly, we need to, make sure that apart from it speaking to different cycles, apart when we now get to have, both reports, addressing the same reporting period, but then we should also see, we can link a number in the financial report to the sustainability report so that we don't have just two silos, but we have two reports speaking to one another.
Okay, that's a good way to put it. Let's go to recent stuff, the COP28 stuff. So how are companies going to address, if they need to, the new EU reporting requirements? So CSRD and CSDDD, and the very lofty commitments coming out of the recent COP28. Ryan, do you want to take that one to start?
Sure. I mean, I think they're going to tackle it the way they have up until now. I think a lot of European firms are already they're used to reporting on emissions. They're sort of used to how to do this, and this is really just an increase in the stringency and sort of spreading it out a little more. I think it's going to be pretty straightforward. I think where we're going to have problems are Canadian firms, right? So CSRD covers Canadian firms that have operations or find it really any kind of touching in any way the European Union. And so I think a lot of Canadian firms are going to find it quite onerous at the start because most of them haven't been required to disclose any kind of emissions at any point in time. And so this is, I think that's where we're going to have the biggest problems. There were quite a few discussions about disclosure at COP. I won't get into all of them, but one of the biggest concerns was interoperability across jurisdictions. And then thinking about at some point moving from disclosure to carbon border adjustments to carbon pricing. And I think those were what I heard. Besides the specifics of particular regimes, those were really in terms of standards, in terms of disclosure, in terms of whatever it is that we're doing, really interoperability across jurisdictions. And then once we get disclosure, well, how do we make sure that if we're producing in jurisdiction A, they've got no disclosure and no carbon taxes or anything, how do we make sure that when we're consuming in a different jurisdiction, that things are sort of up to our standards?
Okay, thank you. And David?
Maybe just to chime in here, we talk a lot about carbon tax, and thankfully we'll be talking about more forced labor, but also a new thing that is coming in is EU deforestation-free regulation, and this is where ESG analysts almost become ESG policy analysts because these have really huge, potential materiality to our investment thesis. When companies, if they don't report on their supply chain and they don't validate that they're not involved in any deforestation in their commodity, they may not be able to operate in the EU or they may be fined. So this is the type of regulation that will be coming in many different ESG issues, and companies that want to operate, even if their headquarters in Canada or in the US, but they want to operate in the EU, they need to disclose and they need to validate that they're not involved in any deforestation. So this is the type of example where investment team will all agree that they need to focus on, because obviously now you're touching the bottom line of a company.
Okay. You guys, we have just a few questions left. Are there any questions there that you're burning, you desperately want to answer? This is if there was something there that jumped out at you. Otherwise, I'm just going to throw one last one out at you. What do you think? Here it comes.
Maybe just a quick one.
Yeah, David, go ahead.
A couple of questions on ESG metrics and compensation and how do we incentivize. It's really just key.
Can you read the question, because the audience doesn't see the questions? So what's the question? Which one?
I need to find it.
Okay. Give us.
I can read it.
Yeah.
I think it's with having incentive plans tied with ESG. Do you find this brings it to the forefront for attention and action? It's from Ellen Pearl.
Yeah, that's the one. David, have at it.
Yeah, so it's really just important that whenever we see any ESG metrics being tied to compensation, that these are reflective of what we see in the ESG report of that same company. So whenever the ESG metric being used for compensation is not aligned with the top goals of the company when it comes to ESG, there's a disconnect, right? When we see that these metrics are aligned and the materiality is there, there's a rationale on why the senior leadership managers should focus on ESG, then everything makes more sense. And I think that bring everyone on the same path. So not having a sustainability team at a company moving in one direction while the management team is moving in another one. So just my quick 2 cents.
Okay.
I would just like to throw one thing in here. This is maybe a pet topic of mine. I really dislike this umbrella term of ESG. I really think firms and everyone should be thinking about specific topics. It's reducing emissions, it's stopping deforestation, increasing biodiversity, getting rid of child slavery, whatever it is. Set these really, I think, because there's just so many goods and evils under the umbrella of ESG. And I think it's such a political hot button topic. I think it does that whole topic in general a disservice. That wasn't meant as a criticism of anyone.
No. In fact,
I like being specific.
Okay, but that broad, let's have a sort of leave the audience with kind of one thought. That was a nice way to end things. Like, think about this. Does anyone else want to give us, Lola, Jeff, David, do you want to give us a kind of like, you're going back, everyone's going back to work. What do you want them to take from this as a kind of final elevator pitch? Anyone?
So I can jump in.
Lola's in, yes.
Yeah, okay. So I would say again to reporting entities, start from where you are, start reading the standards, get help. There's immense help available from different sources. So get that help that you need and just start, and you get perfect as you go along.
That's so inspiring. All right, Jeff, David?
I was going to say the same thing. Just start, get going, start. Ryan gave some great practical examples, even if you're just tracking your activities to start off with. And yeah, avail yourself of all the resources that are out there amongst your industry associations, NGOs, and other experts. I find that people are more than willing to help those that have experience to get others started as well. So.
Okay, that's really helpful.
And I'll conclude by saying climate reporting is definitely more than a check the box exercise. We're talking about real risk. Climate change is real. We're talking about opportunities for people that want to allocate capital. They want to solve solution, and that all come back to trust. If there's no trust, it's hard to move forward. And retail investors would say it. They go to the bank, they look at their ESG fund. Can they have trust in that fund when they say something, right? And that also applies to municipalities. So I saw a question.
Yeah, there was a good
Q&A.
question there about that. Will
Yes,
municipalities have to get into climate reporting?
Manulife Investment Management wrote a paper on our own model for sub-sovereign issuers, province, municipality. They have a budget. They will be impacted by physical risk. Them too, not just corporate. So yes.
Okay. Oh my goodness, this is fantastic, you guys. There's so many more questions, but before I wrap things up, I want to let our audience know a bit more about the Institute for Sustainable Finance, also known as the ISF, because we like alphabet soups, which was the co-presenter of today's webinar. So this is the first ever cross-cutting and collaborative hub in Canada that fuses academia, the private sector, and government with a singular focus on aligning mainstream financial markets with Canada's transition to a prosperous, sustainable economy. The ISF is housed at Smith School of Business at Queen's University. The Institute fills the gap of relevant data, expertise, and business-oriented solutions for sustainable finance. You can learn more at isfcanada.org. There's the URL on your screen. And finally, audience, this is our very last free Smith Business Insights webinar for 2023. I want to thank everyone who's helped put these webinars together, along with everyone who's been a panelist or a speaker this year, including you for today. So thank you. You three, sorry. Our first webinar of the 2024 season happens Thursday, January 18th at 1 p.m. when we're going to be speaking with the amazing Dane Jensen about the 6 meta skills that will help you level up your career in 2024. And I hope everyone will join us for that. To my fantastic panelists, Ryan, David, Jeff, and Lola, I thank you very, very much for sharing your insights with us today. I'm sorry, audience, we didn't get to all of your questions, but they were fantastic questions. Thank you for your engagement. And thanks everyone for tuning in today, and all the best for the end of 2023, and much luck to everyone in the coming year. Have a nice afternoon, everyone.
Thanks all.